Saw a little comeback today, about the best that bulls could ask for, at least the minimum, to hold the line and keep 58 in front of the S&P 500. Red light on stocks since Friday because of the lower lows, lower highs. The chart now has been technically downtrending since the record. Whether or not we find meaningful support here probably depends on how inflation goes this week. It is the highlight, and we've had a lot of pressure in risk assets. We've had a lot of pressure in bonds too. So if there is something cool that comes in for CPI, then seems like you should have a decent little rally. But the inflation pressures are building, and they do look kind of real. The odds that the number comes in light seem pretty low, considering the data have been generally beating expectations, and the implications we've seen from recent economic numbers point towards more heat than cooling. So nothing's changed on the risk radar until otherwise noted. Dollar's been ramping up. Bonds generally look pretty weak. However, given that we've already priced down the odds of cuts and we're really only leaving one lingering here for the entirety of 2025, if the number is below 3%, you might be able to get a little bit of pushback from some of the recent softness in bonds and equities. But here's what I'll be looking at. Very importantly, number one, TLT with the correlation. Alex Coffey kind of stole the thunder a little bit from me earlier, pointing this out. It's a good observation. Correlation's been rising again. It's at 0.8 between TLT and SPY. That means that stocks are taking their cues from bonds again. And it really hasn't been this way since earlier in the year. And it was even a different situation then because we had bonds rallying and stocks were rallying together. Now, for basically call it from September to December, 3 months, we had bonds selling off. And as you can see, the correlation just wasn't there. So equities weren't really responding. Kind of fits and starts a little bit in September when we first put in the low for the yield. But it looks like we're at the point where the elevation of the yield combined with the rate of change is at a little bit of a pain point. I think Zed Francis made a good point with us this afternoon, which was that if you have a move from where we're at right now, which is about 4.8 in the 10-year, up through to mid-5s again, if you start looking at the 5-handle in the 10s, it looks like stocks are going to have an issue with it based on this, which tells us the correlation is pretty high right now between stocks and bonds. That reminds us of 2022, the last meaningful bear market we had, obviously. The other thing that reminds me of 2022 is this, crude oil. This is the commodity index, the GSG. I mean, you've got a lot of strength here in this chart. Again, crude is probably the weakest part of my own personal analysis, so I try not to get too overextended in reading signs of the crude oil market. And it just also feels like at any point, U.S. could just keep drilling even more, and crude has a lid. But if they choose not to, and if oil producers around the world hesitate, then WTI has a potential really interesting move if it gets past 80 bucks. And the fact that that's happening while the dollar is going up is also reminiscent of 2022. But here's where you want to really be watching closely to know if this is just going to be a bit of a growth scare that causes some downside and some air to come out of a stock bubble, or if we're actually in a threatening position again. Because so far I wouldn't describe this really as anything economically threatening. For the most part, it's better than expected news. It's just the stock market's in kind of a bubble, so it's got to reprice a bit. Here's how we'll know, I think, if we're in a threatening position. If the 2-year yield really starts to move. This is a 6-month chart, and the 2-year did have a pretty notable little swing here last week, which suggests that not only are we not going to cut, but if the 2-year starts breaking out higher, that might mean that we're talking hikes again, and that's where you're going to start to get pressure. That's why last week we also saw this breakdown in the regional bank index, KRE. Some firmness today was good as financials rallied, but this is where you'll see the real pain point show up if this becomes a problem. Inflation on Wednesday should be the biggest inflation print we've had in a while.